Hey everyone, today I want to talk about something really wild. Something that, honestly, if I had understood this stuff when I was in my early 20s, I might have avoided some of the deep pits I fell into with my investments. You see this phenomenon, right, where on one hand the Japanese stock market is exploding, hitting historic highs, the Nikkei 225 index soaring more than 15% this year, breaking 38,000 points for the first time. It feels like every headline screams capital feast, especially with those export giants seeing their stock prices shoot up like rockets. But then on the other hand, you have the Japanese yen, just desperately clinging on around the 160 mark against the dollar, almost 40% weaker than it was 3 years ago. Even Moody's economists are saying it is unreasonably weak. Now, for a long time, my understanding of macroeconomics, which was admittedly pretty basic back then, told me these two things shouldn't happen at the same time. When a country's stock market is hitting new highs, its currency should be getting stronger, especially when the central bank is in a tightening cycle raising interest rates. But the reality, a very painful reality for many, is that those rate hikes haven't saved the yen. Instead, it seems to be sinking deeper into this quagmire, almost like it is bleeding out. And for regular Japanese families, their real wages, what they can actually buy, have been falling for 9 straight months. It is a brutal drop. The market's euphoria, this almost reckless excitement, it feels like it is completely overshadowing some really critical, almost fatal signals about the underlying assets. About the real economy, it makes you wonder, is the market wrong, or is there some deeply hidden channel of profit transfer happening here? A kind of epic cross-border arbitrage playing out. What is even more concerning, and this is something I've learned the hard way through my own investing mishaps, is that whenever we've seen these kinds of stark divergences in history, they've often been a prelude to some seriously brutal wealth redistribution, a massive financial reshuffle. So for today's video, I want to take you deep into this. We're going to pull apart the three faces of the Japanese yen and uncover the hidden pipelines that are just frankly sucking wealth out of the system. We'll explore how this Wall Street party, this global financial dance, might impact global capital flows and, most importantly, our own wallets. My goal here isn't to scare anyone, but to share what I've pieced together, often after losing my own hard-earned money, so you can hopefully avoid some of my past mistakes. Let's dive straight into it and look at the yen's first face, its current predicament. Imagine this scenario. And I'll give you a really crude analogy, something I wish someone had told me when I was chasing those sure thing investments. If you could borrow money from a bank right now at an incredibly low interest rate, less than 1%, and then you could take that money and buy a bunch of stocks that are pretty much guaranteed to make you 30 to 50% this year. Would you borrow it? Of course you would. You de-borrow as much as you possibly could, even if it meant selling everything you owned to get more. This, my friends, is exactly what some of the sharpest minds on Wall Street, and yes, some of those who act like financial predators, are doing with the Japanese yen right now. Hedge funds all over the world are treating the yen like an ATM with no password, an unlimited cash machine. Their strategy is incredibly simple and frankly a bit aggressive. They borrow cheap yen in Japan where interest rates are practically zero. Then, they convert that yen into a stronger currency like the US dollar, and then, like a pack of hungry wolves, they storm into the US stock market, specifically targeting AI and chip stocks. After they've made their profits, they convert the dollars back into yen, pay off their debt, and the massive difference in interest rates and the stock gains. That is all pure profit, practically free money. You might think, well, is that just classic arbitrage? And yes, in the financial world. They call this sophisticated maneuver a carry trade. But the scale of it, that is what is truly mind-boggling. Let me throw a number at you. In January of this year, the U.S. Commodity Futures Trading Commission, they released some data, and it showed that the net short positions on the yen held by hedge funds and speculators had reached their highest level since 2010. Bloomberg, always a great source for getting to the heart of things, put it even more bluntly. These funds combined had amassed bearish bets on the yen amounting to roughly 28 billion US dollars. Now, understand this isn't just one fund's position. This is the collective assault of global speculative capital on the yen, a whopping $28 billion. You might not have a feel for what $28 billion really means. So let me put it in perspective. In April of this year, the Japanese government actually spent 34.5 billion US dollars, real money, to intervene in the currency market, trying to buy back yen and give it a lifeline, trying to prop it up. What happened? The yen caught its breath for a fleeting moment, but then it quickly plummeted back into the 160s, back into the abyss. It is $28 billion of short positions against $34.5 billion of national intervention. The market simply wasn't intimidated. Why? Because the logic behind shorting the yen is incredibly solid. So solid that Wall Street isn't even bothering to hide it anymore. The Bank for International Settlements, the BIS, they put out a report in May, and they directly named it speculative trading, holding massive net short positions in the yen, a clear sign of active global carry trades. But the truly brutal truth, the part that really stings, is still to come. Have you ever considered what did that $28 billion of short selling capital eventually get exchanged for? What stocks did they buy? The answer is almost all of it went into NASDAQ, S chip stocks, into Nvidia, into TSMC, into all the American tech giants connected to AI. Think about it. In January, these hedge funds were aggressively shorting the yen and going long on us tech stocks. By May, semiconductor ETFs were up more than 60% this year. Let S do some basic math, the kind of math I wish I defocused on instead of chasing those high-risk, high-reward schemes. Your cost to borrow yen was less than 1%. The semiconductor ETF you bought went up by 60%. How much did you net? You don't need to be a financial genius. You just need a basic understanding of arithmetic to see how insane these numbers are. This, my friends, is the first face of the Japanese yen. It has long stopped being a normal currency. It has become the cheapest fuel for the global AI party. The cheaper the yen gets, the lower the cost to leverage up and buy stocks, and the more vibrant Wall Street S party becomes. Wellington Management Company, a firm that manages over $1 trillion in assets. They wrote something incredibly blunt in an analysis piece earlier this year. The last time the carry trade unwound on a massive scale, the biggest impact wasn't T on Japan. It wasn't T on the foreign exchange market. It was on U.S. momentum stocks. Read that sentence again. Really let it sink in. If the yen carry trade blows up, the first place to suffer a brutal shock is in T Tokyo. It is NASDAQ. How did this almost perverse relationship come about? Frankly, the underlying logic of the yen carry trade isn't T about shorting Japan at all. It is about leveraging up U.S. tech stocks, the people borrowing yen. They don't care about Japan's fate. They only care about one thing: how to use the cheapest money in the world to buy into the most expensive AI dreams. The Bank of Japan raising interest rates to 0.75%. For ordinary Japanese citizens, this means mortgage rates go up and life becomes even harder. But for the capital sharks on Wall Street, what does it mean? Oh, the cost of funds went from 0.5% to 0.75%. That is like going from almost free to still very cheap, right? Would you stop driving your car if the price of gas went from $2 to $2.5? Probably not. As long as your destination is worth it, but here's the kicker. Isn't the Bank of Japan supposed to be raising rates? They went to 0.5% last December, then to 0.75% this January. In theory, rate hikes should strengthen the yen, right? So why is the yen getting weaker, like mud, instead of stronger? Because theory is one thing, and the brutal reality is another. While the Bank of Japan is at 0.75%, look at the Federal Reserve. The Fed's benchmark interest rate is hovering between 4.25% and 4.5%. Take a moment to really grasp that massive, almost absurd gap. You borrow money in Japan at 0.75%, and you can deposit money in the US at 4.25%. That is an almost 4 percentage point risk-free interest rate differential. This gap is so wide that even if the Bank of Japan hiked rates to 1%, it wouldn't close it. Even at 1.5%, it would still be leaking money, as long as the US doesn't cut rates and as long as AI stocks keep soaring. Wall Street has absolutely no reason to stop aggressively withdrawing money from this. Frankly, broken ATM in Tokyo. Following that logic, you might already be seeing the second face of the yen. This face isn't in the greedy hands of Wall Street, but in the desperate reality within Japan itself. This past February, CNBC ran an article titled, "Japan's stock market is surging to records, but this rally might be fragile." The article quoted a well-known investment veteran who said something incredibly honest. This rally is driven by economic fundamentals. If you look at how the exchange rate is moving, how the economy is performing, there is nothing particularly strong to support this market. And he was absolutely right. Japan's GDP in the third quarter of last year actually contracted, an annualized contraction of 1.8%. This was the first contraction in 6 full quarters, yet at the same time, the Nikkei 225 index was shamelessly hitting new all-time highs. Automobile stocks, electronic stocks, machinery stocks, all of them were going crazy. Does this sound outrageous to you? Actually, it is not surprising at all because the revenue structure of these listed companies explains this absurd party. Think about it. Toyota, Sony, Hitachi. What is the key word for these giants' exports? Their products are sold to the US, Europe, Southeast Asia. The money they earn overseas is in hard currencies like US dollars and euros. But when they report their earnings on the Tokyo Stock Exchange, those dollars have to be converted into yen. The more the yen depreciates, the less it is worth. The larger and more impressive the converted yen figures become. This isn't because their companies suddenly became more competitive. It is because the ruler they reusing to measure their height has gotten shorter. Toyota, in early May, just released its fiscal year 2026 earnings report, with annual revenue hitting an astonishing 50.68 trillion yen. Think about it. If it weren't for that extremely weak, dog-colored yen, how much would that revenue figure shrink? Moody's economists used a very precise term. The fact that the yen is currently severely undervalued, that is actually the invisible hand behind this Japanese stock market rally. Invisible hand, not technological innovation, not increased productivity. It is entirely fueled by currency depreciation, by sucking wealth out of the system. On the other side of this feast, Data released in April showed that Japanese household consumption spending had fallen for the third consecutive month. Real wages, meaning what people can actually buy after inflation, were down 1.4% year-on-year. This marks the ninth consecutive month that real wages for Japanese people have fallen 9 months. Go to the supermarket and see soy sauce is more expensive, rice is more expensive, electricity bills are up, and gas prices too. Because Japan imports almost all its energy from overseas. A depreciating yen means the import price of every barrel of oil, every ton of gas, is skyrocketing. Even if the numbers on people's paychecks went up a little, they can buy less at the supermarket. This is the most brutal form of imported inflation. It is not because you've become poorer or you are not working hard enough. It is because the hard-earned money in your hand is worth as much anymore. And at the other end of this chain are the shareholders of those export companies, their executives, and those overseas investors who hold Nikkei 225 index funds. Their assets are aggressively expanding, all at the cost of the depreciating yen. Remember this: wealth never disappears into thin air, wealth only shifts. From whose hands to whose? From the hands of struggling Japanese salarymen earning yen wages, from the housewives buying rice at the supermarket, from the elderly living on meager pensions after retirement. It is being forcefully taken from them and transferred to those who hold shares in export companies. And most of these people aren't even in Japan. According to data released by the OECD last December, Japan's GDP per capita has plummeted to 24th among the 38 member countries. It is directly behind South Korea, once the formidable second largest economy in the world, the creator of the Asian economic miracle. Now its GDP per capita is at the bottom of the developed countries club. This is the yen's second face. It is a cruel, invisible wealth transfer belt. It uses the depreciating yen to inflate the beautiful financial reports of export giants. It uses the shrinking purchasing power of ordinary Japanese citizens to aggressively subsidize the Nikkei index funds held by global investors. You might ask, are the Japanese government officials just sitting there doing nothing? Export companies are making so much money, surely tax revenues have also increased significantly. Why does the government use that money to provide subsidies and relief to its citizens? The answer will make you even more disheartened. First, a significant portion of those profits, which swelled due to the depreciating yen, never actually returned to Japan. They kept firmly overseas. Why wouldn't they come back? Because once dollars are converted back into yen, the exchange rate losses would significantly erode the paper profits. So this money just sits idle in the accounts of overseas subsidiaries, neither investing back home nor giving Japanese employees a single cent more in wages. Last November, the Japanese government did indeed put on a show and launched a fiscal stimulus package of over $135 billion, talking about tax cuts, subsidies, and cash handouts. But where did the money come from? All borrowed. Japan is already the most indebted country in the world. Adding more leverage to provide subsidies, in essence, is just using tomorrow's money to patch up today's holes when interest rates genuinely rise tomorrow. Who will clean up this massive mess? So, you see, this chain of interests is far more self-contained than you might imagine. Exporters make a fortune from exchange rate differences. Their money stays overseas. The government wants to appease the public, but can only do so by borrowing money. Borrowing money pushes up the national debt, making the Bank of Japan even more reluctant to raise interest rates. The central bank dares not raise rates, so the yen continues to depreciate. The yen continues to depreciate, and exporters continue to make easy money. In this perfect vicious cycle, the only one being repeatedly crushed is the Japanese housewife standing in the supermarket, looking at the price tag, and reluctantly putting the beef back on the shelf. Now, I want to show you the most terrifying scene, and that is the yen's third face. This face is firmly hidden within the Bank of Japan's balance sheet, and it is the truly desperate reason why the yen cannot be saved. Here is how it works. On the Bank of Japan's balance sheet, there is a mountain 10,000 times heavier than Mount Fuji, and it is Japanese government bonds. How many government bonds does the Bank of Japan actually hold? Let us use a number to really make you understand. By the end of 2025, the Bank of Japan's total assets will be approximately 697.95 trillion yen. That is about over $4 trillion. The vast majority of this is Japanese government bonds. Think about what it means for a central bank to buy government bonds. Simply put,